Hello. Today we're going to discuss about the pricing. In other words, we call it rate making. Before we start doing on pricing discussion, I'd like to discuss first the terms used in non-life insurance field. The first one is it's called exposure. Its original meaning is a state where the loss is possible. Then the second, exposures, that's number of units for pricing or measuring units for probability of size of loss. Then event occurrence. This is incurring constructed event during a short period. In a short period, I meant is like a policy year, 1 year. Then it says a claim. The claim is requesting the insurance payments on incurred loss from the party who got injured. And insurance loss is the amount of claim which the claimant is claiming against insurance company. And then loss adjustment expense is kinds of expense required to close claim. There are two types of loss adjustment expense or LAE. The first one is called allocated, which means that it's assignable to a specific claim. Example is a lawyer's fee. The other is unallocated LAE, that's unassignable to a specific claim. Example is like employee's salary. Next, there's a called paid loss. That's insurance loss paid to claimant to compensate the injury of the claimant. The case reserve is a reserve estimated by claim adjusters for a claim. And then outstanding reserve or OS reserve is case reserve minus the partial payment if it's allowed to pay partial payments. And then the important item is called IBNR reserve. That's incurred but not reported claim reserve, which is usually estimates made by actuary. That is one of the important concepts of the in actuarial reserving analysis. We're going to discuss the next chapter, next session. And then next one is called incurred loss. That's cumulative paid loss plus outstanding reserve is based on the action year concept. But this is a paid loss during certain period plus change of outstanding reserve, which is concept based on the calendar year definitions. So we're going to discuss later the differences between these two concepts. And then ultimate loss is kind of incurred loss plus IBNR reserve. That's loss that insurance company has to pay eventually. Ultimate loss is also defined only with accident year concept. The next term we call frequency. The frequency is number of claims per exposure. Then severity is like average loss per claim. There are two types of pricing or rate making. The one is called manual pricing, and the second one is individual pricing. The manual pricing is kinds of a pricing using the class and territory. Individual pricing is pricing for a certain individual policy. There are three types of individual pricing. There's a schedule rating plan, expense rating plan, and loss rating plan. We're going to explain further on those three rating plans. And another the concept we're going to discuss is like One is prospective rate making versus retrospective rate making. Prospective rate making is rate making or pricing based on past history. And while the retrospective rating plan is the data based on current period. We will discuss this concept a little more later. The first, we discuss about manual rating. Manual rating, I said before that, calculating rates which applies to each individual group. Here, individual group is classified by class and territory. That's typical classification includes in US. And class territory is a group in which that every number gets the same rate. So every member gets same rate. Any fluctuations of claims, which is going to be ideally based on just random occurrence. Now there are two methods of manual pricing. The first one called pure premium method. The second one is called loss rating method. In pure premium method, we calculate rate for exposure directly as like R equal P parenthesis open 1 minus V minus Q parenthesis closed, where R is a rate, Q is like a pure premium, where that's L over E, L is loss and E is exposure. V is expense, company expense, and Q is a profit and contingency. Here contingency meant for risk charge. So the concept of the pure premium is that the amount per exposure returns to insured. So as pure premium is other than the company expense and profit and contingency. The second concept of the rate making is called loss rate ratio method. Here we calculate change of rate. Say R equal A times RO, R new rate, and RO is the current rate, and A is W over T, where W is experienced loss ratio, T is permissible loss ratio. So here, loss ratio is ultimate loss over earned premium. The concept here says that if experienced loss ratio is higher than the permissible loss ratio, then the rate has to be increased, vice versa. Here, permissible loss ratio is like a ratio where the expense and profit and contingency charged for insurance company being able to continually operate with normal profits. So if the ratio is permissible loss ratio, then the company only earns the normal profits. If the ratio is higher than that, the company is losing money. If it's less than that, then the company makes too much money. So this is permissible loss ratio is kind of the rate which the insurance company targets to meet. Okay. In pure premium method, does not take into consideration of prior rate, but loss ratio method does. So this means that the loss ratio method is more stable and preferred method used more often. Because the pure premium method, if we use, it can be unstable because it doesn't take into consideration of the what was the prior rate. So it can jump all over the places if the data is not stable or not. You don't have enough data for that. Okay, then we have like a consideration for credibility. If the data is not enough, then you have to consider their credibility. The credibility is the degree of the credible amounts between 0 and 10 and 1. We'll talk about more in chapter 4 for credibility theory, what is the credibility is. But when you make rates, you have to consideration of the credibility theories to compensate for not enough data. When you do rate making by class and territory, because if you split all those data by class and territory, you're not going to have enough data. So because of that, many times use the relativity concept. The current relativity is like a weight ratios set 1.0 for biggest class territories. So it's like a comparative rate. So then you company experience loss ratio for each class and territory. Then you get the proposed relativity for each class and territory by dividing each loss ratio by the standard one. And then you apply credibility. And then finally, you're adjusting the off-balance effect to make final rate change. The off-balance effect is like adjusting difference between the total rate change and average rate change from the rate changed by class and territories. And because you also apply credibility, that rate from the class territory cannot be the same with the total rate change. So we have to make that adjustments. Now we discuss about the individual rate making. This is like to assist or compensate for manual rate making is individual rate making. So the individual rate making is adjusting individual entities rate by applying its experienced value or its risk characteristics. The types is, there are two types, I think I mentioned before briefly, is prospective rating plan versus retrospective rating plan. And prospective rating plan, you use the past experience, but retrospective rating plan, you use current experience. In prospective rating plan, you decide future loss cost using the past experience or past risk characteristics. In retrospective rating plan, you decide final loss cost using the current same period experience. So here you first set deposit premium and then you adjust final rate after policy expired. In prospective rating plan, there are three types of rating plan. The first one is called schedule rating plan. Schedule rating plan providing credit and debits by investigating the risk characteristics of the individual risk, here individual policy. Usually, because there are so many many items you're giving credit debits, you usually set max amounts as like a 25% or 35%. 25% is more common in US. The example of this characteristic is like a safety related to characteristics or years of experience or years of building built. Those are kinds of examples. Based on those, you give debits or credit. And then second one is called experience rating plan. And comparing the certain entity's own experience, here experience, I meant loss ratio, with the expected loss ratio. Then we apply the credibility to calculate credit debits for new rates and how many credit debits you're going to give to the manual rate. The formula is like actual experience loss ratio over expected loss ratio -1, and then times the credibility. The next example shows based on the actual and expected loss ratios and then credibility, how much rate increase insurance company is going to charge from the manual rate. And then a loss rating plan. In loss rating plan, a certain entity is large enough to use its own experience to make its own rate. So here you are assigning like full credibility applied to rate change. So the own experience loss ratio over permissible loss ratio minus 1.0 is going to be a rate change from prior rate. Okay, the next one is retrospective rating plan. It's a plan here. Final premium you calculate using the experience during the policy effective period. So after policy expired, final premium is calculated based on the current experience with agreed parameters. Here the example was like a risk charge amounts is one of the example of the agreed parameters. And this is this rating plan is more sensitive to the experience rating plan because this is that the rate change directly charged to current policy, not the past policy. Okay. The scheme is like first you set the deposit premium. Usually it's called a standard premium, calculated using the experience rating plan. You also add here schedule rating plan too. Then you set up minimum and maximum premium. This is agreed between the insurer and the insured. So for example, you can set up the maximum premium 1.5 means that 1.5 times of your standard premium is going to be maximum premium. And then you also can set up like a 0.75 for minimum premium. So the 75% of your standard premium is going to be a minimum premium. And then there's going to be a risk charge for maximum premium. It's because if loss occurred are more than the amount for maximum premium, then insurer has to take loss from this account writing. So this is its only possibility. So you charge for that. So this is going to be a risk charge. And also there's a concept for risk saving. Yeah, because if the loss ratio is lower than minimum premium equivalent loss ratio, then the insurance company gets extra money on that. So for that, you return to your insured. It's called the risk saving. So the actual charge is going to be risk charge minus risk saving. This is going to be one of parameters you set up to use the retrospective rating plan. So this is like a strongest loss control rating plan because the it's going to be the loss experience is going to be directly impact on the current premium. Typically the insured is giving extra conscious on the loss prevention activities. So this many times in the US they use for workers' comp business for these types of retrospective rating plan. Okay, today we discussed about pricing. The next time you're going to discuss about the reserving analysis. Okay, bye-bye. Yes.